It's lovely to see so many people on the call and here to participate and get an update. Happy New Year. I just appreciate the updates that we're about to get from our colleagues with Crucial Consulting in New York, and then Lawrence Miller here to update us on the Vermont Mission investment portfolio. It's a great turnout today, so thank you for joining us. Do want to recognize a few folks on the call. For those who don't participate regularly, the investment oversight at the VCF is a bifurcated approach. We have independent advisors in New York who advise us on the portfolio, and we have a volunteer committee composed of directors and independent committee members. And I see Tim Briglin here, who's a director, on the board of directors at the VCF and chair of the investment committee. I'm scrolling quickly. I see Barry Pius, who's our vice president for finance, who really staffs the investment committee. John Vogel, who chairs the Vermont Investment Portfolio Committee. Annie Grady is VP for operations and administration. I'm just making sure in terms of, I just want to call out those who are participate in our governance process.
Cindy Char, board of directors, is also on the call, Dan.
Great, thank you. Just appreciate the collective effort that goes into the responsible governance and oversight. Philippe Rivera, our VP for strategy and communications, also on the call. So anyway, it's lovely to see everybody. I want to turn it over to Mike Miller, who our colleague at Crucial Consulting, to give us a bit of an overview and update on the performance of our broad, long-term and socially responsible portfolios.
Thanks, Dan, and good morning, everyone. Nice to see so many of you today. There's so many things to talk about, and I'm sure everyone has a list. But we're in an extremely complicated time, as you know, and I'll tie that into what Dan just described. I'm going to share my screen, hopefully successfully here, and hopefully with the right. I had it. I don't have it for some reason. Oh, here it is. Yes, right there in front of me. Can you all see this? Okay, I'm going to make it bigger.
It's good.
Bear with me a second, though. Oh, good. Thank you. Okay. So I'm going to touch on performance fairly quickly, only because it's backward looking, and I want to get to a little bit of the strategy today and how we're navigating some of these very complicated waters that we find ourselves in now. And while I'm not commenting specifically on the waters because they're different today in many ways, but I will tell you, having uncertainty, having risk, having volatility, having complexity aren't things that we're actually afraid of. I will say, I think I don't think the world needs what's happening to it right now, but I think capital markets need a dose of reality, and I think that's part of what is likely to happen in the future. And I think it's important for us to talk about how that affects the portfolio, how it affects the strategy, and how you might want to think about it as individuals as well. So this shows you the performance of the various pools. Dan referred to the socially responsible and the long-term pool. You can see the long-term pool outperformed its benchmark last year, despite not owning very much in that quote-unquote Magnificent Seven. And just for those of you who haven't seen these numbers, if you look at, for example, the S&P 500's return last year, 22% of its gains, and I kid you not, came from one stock, which was NVIDIA. Another 32% of its gains came from the other six magnificent stocks, which left only less than half of the index's returns came from 493 stocks. So it's a fascinating thing. And of course, one person might say, well, those stocks deserve to go up that much. I would actually argue with you quite vociferously that's not true. This is a bubble. But needless to say, it's interesting. And as 2025 has unfolded so far, we're starting to see some of the reality kick into the market. So it has not nearly gotten to a place it'll probably end up. The long-term pool outperformed despite not owning those stocks because it owns other stocks that did very well. There were ways to successfully invest prudently and still outperform. It is still lagging, as you can see, over the periods out to 10 years, only because of this issue that it's more value-oriented, it's more globally diversified than 10 years. And since we started working for the foundation, the returns are quite strong. The SR pool actually had a step back last year as well. That actually mainly happened at the end of the year after the election, where some of the things that are done in that portfolio around environmental impact, around having a planet that doesn't kill us by warming too much, and all these things have obviously, those stocks have reacted to the election in a sense that I guess we're just going to burn coal all day now and not do any more wind or solar. That's the way the stock market acts. I'm not being serious when I say that. But needless to say, that's hurt the performance more recently there. And then the midterm pool is largely an index pool, which is why it tracks the index so closely. So if you turn to here just for a second, I want to talk a little bit about why we think about performance the way we do, which is in really long increments. So the numbers, this is just the long-term pool because it's got the longest record. But the blue bars are that first line you saw on the prior slide. The red bars are the line underneath it. So you can see the 9.7 versus 9.4. But then just for a second, if you look at these numbers to the right, the 7.5 versus 7.1, even the 6.4 versus 7.0, they look like very, very pedestrian numbers. And when you look at them this way, which is after they're compounded over time, you see a very different picture. So these are the exact same returns. The difference being those were per year, and this is what long periods of performance compound into, which is why a lot of times when we're not quote unquote getting it and chasing after what's working in the market, it's because our biggest fear isn't really underperforming, although I understand the risks when we do that. Our biggest fear is failing in the long term. Short term, we'll take some short term disappointments and short term discomfort, but we will not trade it for long term failure. And I think that's the key point here. When you look at 15 years and since 2002 when we started, you can see the returns are significantly above the benchmark, and in a way that's meaningful to the foundation and meaningful to your funds. I'm not allowed to promise things, so I'm not going to, but I will say, I'll show you a little bit later. This is despite the world, despite the complexity. And I can't even believe I'm saying this, but this is one of the most compelling investment climates we have ever seen on a forward return basis. And for this portfolio, and I'll talk about that in a second. So looking at the socially responsible pool, one of the things you probably have noticed in your lives is when you look at the returns of a manager or mutual fund, whoever you're looking at, you'll frequently see either a really good record, and then you'll say, well, they're really good. I'm going to go hire them. Or you might see a record that's disappointing. Say, well, I don't want anything to do with those people. And the problem when you do that kind of analysis is that the assumption, of course, is that if things are good, they will stay good. If things are bad, they will stay bad. And it ignores the cyclicality that is actually embedded in returns. Like geniuses look unbelievably dumb at certain points in time. I'm not saying we're a genius. I'm saying when I look at managers, fools can look very smart over short periods of time as well. And so how you know the difference, of course, is complicated. But there's a way to actually tease out when people are skillful, when they are not. And the answer to that is to do so by looking at multiple ending points. So don't just look today, look 6 months ago, look a year ago, look 5 years ago, look 10 years ago. What did they look like? And that's what this analysis is doing here for the socially responsible pool. It's essentially taking every single 3, 5, 7, and 10-year period from 2010 to the end of last year and saying, how did the portfolio do against its benchmark? And if you look at, that's what the batting average is. Of course, a baseball player would kill for these averages, and an investor, these are good. 50% means you have no skill, just to be clear. So once you're above 50, you're showing some skill, because if it's 50-50, that's just a coin toss, and who wants that? But if you look across these batting averages, what this is saying is that the socially responsible pool has outperformed its benchmark on a 10-year basis 92.7% of the time. That's higher than the 3-year basis, which is exactly what we'd expect for a very simple reason, which is that when you're doing long-term investing, to use an analogy I think you've heard me use before, like Wayne Gretzky was a great hockey player because he skated to where the puck was going to be. We are trying to invest to where we think the markets are going to go, not where they are. And I think that's an incredibly important way to think about this. So those high batting averages make sense as you go through time, because when the puck does get to us, it just doesn't get to us when we think it will sometimes. The median outcome measures how much did the portfolio outperform its benchmark on average, the good days and the bad. And what that's meant to do is ask the question, is it worth it? So for example, if the median outcome was like 0.2%, you'd be very reasonable to say, well, why would I bother? Why take the risk and offer no outcome? These are cumulative, so it's not per year, but 6.4% is a pretty good outcome. It's not as good as it could be, mainly because we do use more passive management in this portfolio. When we use passive management, we're tracking the index, but so we dampen some of the ups and downs. And then the last thing to look at is best and worst case outcomes, because what you want to see there is you want a best outcome that's better than a worst outcome. You don't want to have feast or famine, which I'm going to come back to that in a minute too. And you can see for 3 years, and we're kind of just a little negative. 5 years is and too, but then 7 years and 10 years, the gap is quite sizable, which is important. Now we have a longer time set for the long-term pool, which you recall is the one that's been struggling more often than not lately. And its batting averages are quite similar, including out to the 10-year period. So both of these pools have been very, in my opinion, very well managed by the investment committee, to be clear. The median outcomes here are much higher. And that's because this pool uses more active management. It didn't have as much of that dampening effect. By the way, had we had more passive in the portfolio the last few years, it would have done better. And so that's certainly something that's affected these numbers. And now you can see, though, these medians are very large. I mean, that's 30 percentage points of outperformance over 10 years on an average basis. Again, not per year, but divided by 10, simplistically 3% a year. And then you also see the best and worst case outcomes, are significant skew towards the upside. So these are really, really, this is the right way to look at any kind of performance. What it doesn't answer, of course, is the have you lost it question. I would argue that the foundation has not lost it by any means. This is a portfolio that's built on diversification. It's built on structure. It's built on the laws of finance, which do get ignored over short periods of time like we are in today. So this is the approach that's used. There are no acts of genius. So by the way, we're not going to tell you whether there'll be a recession this year. We're not going to tell you exactly how some of these new policies are going to affect the economy. We have opinions, but we don't know for sure what's going to happen. And that's how this works. Think long term. We don't make changes to the portfolio based on some kind of opinion we have about the future. We do make changes to the portfolio based on reacting to markets. And by the way, I will tell you, the secret to surviving, at least from a financial perspective, these next 4 years is going to be to watch markets go to very significant extremes in certain areas, and with wisdom, with study, take the other side of some of that, because a lot of short-term thinking, a lot of panic, a lot of emotion, and there's a lot of opportunity created out of that if you know how to choose one thing from another. And then last but not least is never be too sure of yourself and diversify. Always an important thing to do. So these are the mixes of the three pools. I won't spend a lot of time on this other than to say that the long-term pool and the socially responsible pool have relatively similar risk profiles. The difference being the long-term pool has hedge funds and private assets. Hedge funds are exiting the portfolio as we speak, so that's going to go away. But for the most part, these pools are, again, very static when it comes to their mix. But inside of it, there's a lot of things happening. Just as a quick reminder for those who have not been on these calls or have been on these calls before, Special Opportunities is kind of a conglomeration of very interesting concentrated managers. Actually, there's a manager in that portfolio, which I think in the next 3 to 6 months is going to have this crazy event happen that's going to be a very public thing, a very good thing. And when it happens, I'll be sure to talk about it on one of these calls, I hope, because it's one of the more exciting things we've seen. But it's I can't talk too much about it because it's material, non-public information, but it'll be really interesting, and it's on track to happen in 3 to 6 months now, I hope. So I'm going to keep going. I'm going to skip past this, if you don't mind, which is just about the manager's selection piece, and get to the world, because I think that's what people find more interesting today. So these are things we've talked about before, which is why what's going on in the world now is not incredibly shocking. I hate to say it's shocking for people as people. It's hugely shocking, but the fact that it's happening has kind of been in the cards, I'm afraid, for a little while here. So first point, we have higher inflation. People can debate all they want about this, but the reality is it's structurally higher today. It's not going to 7 or 8 and 10%. We're not talking about that kind of crisis, although there are some scenarios, I guess, now where it could. But more likely, it just sits around 3, 3.25, 3.5, which sounds like not that bad, but it's a lot more than it's been. And it changes the way central banks behave. The Federal Reserve can't pump trillions of dollars into the economy if we have inflation that's well above their 2% target. And I think it's incredibly important. And once you remove capital from the system, which is what the Fed's doing right now, by the way, you create capital scarcity. And there are very few people in the professional, very people talk about this, and I think people should have experienced it. We haven't seen capital scarcity in a meaningful way for well over 15 years. And so a lot of people don't have memories that last more than 3 months. So 15 years is a long time. And there's a lot of investors, a lot of advisors, a lot of investment companies, not this one, that do not know what that looks like. And it's risky. It's really risky. You can't just throw money at ridiculous, stupid things and just think they'll work out. Scarcity creates bankruptcies. Scarcity creates all kinds of problems and issues. And if you're not thinking about it, you're not thinking about risk the correct way. And this portfolio very much has that. Geopolitical stability, where do you start? But that's obviously a massive theme, roiling markets, on an hour-to-hour basis. And the cognitive dissonance for us is this. We are absolutely not anti-index, to be clear, but the indexes have become, particularly S&P 500, a bit of a shell of itself because it's too dominated by these 5, 6, 7, 10 companies. And concentration, which is what the index has today, is the synonym of risk. And what we're struggling with a little bit, or a lot of it, is in a world like this one, where you have inflation that's structurally higher, where you have capital scarcity, and where you have all this geopolitical instability, how do you justify taking more and more risk? That doesn't really make a lot of sense to us. And that's the big issue for us in the portfolio. So this is a chart we've shown you before, which is meant to illustrate this point, which is, as you can see, the index is more concentrated than it ever has been in history, actually, right now, as far as, let's go back to 1990, it goes back further too. The last time it even got concentrated in any kind of resemblance of this was back in their last asset bubble, which is the TMT bubble in the late 90s. And now we have the AI bubble, we call it today, or the oligarch bubble. And what you can see here is this weighting, 35.7% in the top 10 names, is extremely high by historic standards. Again, that means the index is more concentrated in these names. And what's really interesting about this is the 7 names. They're very different. By the way, they're not all absurdly expensive. Some of them are, some of them aren't. But they have some things in common. One is they're monopolies. And so that's clearly, people see that as a good thing, but it's not a good thing if there's some kind of antitrust legislation that eventually comes up to try to break them up. Second thing, probably of more concern, is their dependence on China. Frankly, if I walk into a room with a lot of investors and say, how much you want to invest in China? A lot of people don't, which may or may not be the right answer. But the reality is then you say, well, why do you own Apple then? Why do you own Tesla? These stocks are tremendous dependence on China for their businesses. And so you're making the same exact bet. AI hype, and it is hype. So AI is a real thing, just to be clear. The hype is around something very simple, which is the certainty people have about how exactly this is going to play out. And that is a laughable idea. There's no way people know exactly how this is going to turn out. Is NVIDIA the big winner? Maybe, maybe not. One thing's for sure, which get to the bottom right, is people are so sure of it that the optimism baked into these prices is disturbing. And frankly, the analogies are easy to make. Go back and look at Cisco stock in the late 90s. It was going to be the dominant hardware provider to the internet. And lo and behold, here we are 25 years later. The internet's a big thing, and Cisco is not. And so that's probably what happens in NVIDIA too, by the way. Sorry to say, guys. And that's that last point, high levels of investor optimism. And that's what's being broken down in the market as 2025 starts. So the portfolio is off to a really good start in 2025, relatively speaking, in part because it doesn't own these names and because reality is starting to kick in, whether it be Alibaba doing AI, whether it be DeepSeek, all these things. And these are just little things. There's shots across the bow that people probably are going to ignore, but they shouldn't because the risks are really significant here. So this is just a way to think about risk taking. So this is a chart from B of A of global fund managers. And what you can see is that basically, for the most part, the only thing you need to take away from this graph is that December 24 is one of the highest readings since the last 25 years in terms of the aggressiveness of fund managers and people putting more and more money into the US market. I think you've all heard the US exceptionalism argument. The dollar is going to go up forever. The US stock market is going to outperform forever. And all these things reflect one of the greatest phrases in investing, which is risk is greatest when agreement is greatest. And that is exactly what we're seeing today. It is very hard, I will tell you, for someone who believes like I do and we do, crucial in global diversification and value investing, sometimes going with growth, of course, because people look at you like you're insane. Like, why would you ever do anything but buy US stocks? And it's a really, really interesting conversation today. For us, it's a hard one because it's hard to communicate why we're saying what we're saying. I'll show you one example. It's an easy one because to us, we're just licking our chops. This is always turns in the end, and only those who are prepared can win. Okay, so let's just break down one of the arguments for the US stock dominance, which is that the only place in the world, any place that you can get great earnings growth and great businesses is if you buy the Mag 7 and the top 10. And so just to be clear, those stocks are trading, right now at prices that are about 40 times earnings. Depends on the stock, of course, but that's just a cap weighted average. Earnings are growing at about 20% a year, which is incredible, by the way, for companies of this size and scale. And that's part of the argument for why they got done as well as they have. And everything else is essentially. So what you're looking at here is a portfolio that's part of the foundation's long-term pool, which is a manager called Silchester International. They're actually one of the great non-US managers of all time. This is what happened, though. They're a value manager, to be clear. I know it's a dirty word for some of us, but they are a value manager. They only like to buy cheap stocks. And what you can see here is in 2024, their portfolio of about 130 European and Japanese companies had its earnings growth 30%, 29.9. Dividends grew almost 14%, and book value grew almost 3.4%. That leaves basically what they call intrinsic value growth of 16%. But focus on the earnings growth of almost 29.9%. That is a growth rate that has and probably will exceed the Mag 7s, to be clear. The EFA index, which is the index of the stocks in that Europe and Asia, has only grown 2%. So the argument people make is not wrong. There is a lot less to do outside the US to have earnings growth, but it can be done. And that's what Silchester is doing. And what's really interesting is not 40 times earnings for this portfolio, but 10 times earnings, plus a 5% dividend yield. So we can pretty easily pencil out 15 to 20% expected return on a portfolio like this for the next 5 years. Could the Mag 7 do that? Sure, but then it'll have to go to 50 and 60 times earnings to get there. And we're not looking at that at all for this kind of a portfolio. So I offer this just to say that growth is not concentrated in just these 7 names. Yes, they're the biggest growers and they're generating the most kind of a flywheel effect right now, but there are some chinks in the armor as we start to see. And isn't it better to own companies that are also growing really fast where you're not taking on that risk? And that's what we're basically saying. And last but not least, the time I have left, I want to talk about another fallacy out there, which is that growth stocks are always better than value stocks. So this chart, which is a little complicated, but let me just walk you through it, shows you how growth stocks are doing compared to value stocks using value and growth indices. So when the line is dropping where it's white shaded, that means growth is outperforming value. The gray, when it's rising, is values outperforming growth. So the first thing is a lot of people say to you, why would I not want to own a growth stock? And the answer is, well, you do want to own things that grow. I mean, intrinsic value at Silchester is growing quite quickly, but you don't want to pay too much for it. And that's what always trips up the growth investors at the end, is they pay too much for things frequently. So that middle of the graph, this is through September, which is when they did it. So there's no update. Sorry about that. But you can see that the growth stocks have returned just slightly more than value stocks over time. So this dominance argument is pretty weak, particularly given that growth stocks have been crushing value stocks for the better part of 15 years, and they're still just barely above since this index started in 1979. But the more important things on the top right and the bottom right, where we circled the numbers. So what this is doing at the top right is it's taking just the average of the periods of time when growth stocks outperform. What do they do versus value stocks? So value stocks, to start with them, did 14.8% per year, which, by the way, I'm sure we would all agree that if we had an equity portfolio that did 14.8% per year, we'd be perfectly happy with that. Except that when you see 29.4, which is what the growth stocks did, you're like, well, I would have rather had that. And who wouldn't? But now look at the bottom. This is when value stocks outperform. They still crank out 13.8% returns per year. Very nice return, very mission supporting return, an impact supporting return. Growth stocks do 0.6% per year. And I will tell you right now, I will stick my neck out and say the following, that if in 5 and 10 years, if the growth stock indices in the United States, large ones, have even a positive rate of return, I will be surprised, most likely negative. And the key point to think about here is value stocks are steady Eddie to some degree. They provide returns. There's a floor under them because they're already pessimistically priced. They're already inexpensive. Growth stocks, there's a lot of optimism in those prices, and people ultimately get disappointed. Reminds me of the founder of Silchester had this very interesting statement he made many years ago, which was to say, people would be well advised to remember that the world muddles through. When we get too optimistic, we're going to be disappointed. When we get too pessimistic, we're going to be pleasantly surprised. Let's hope that's true today, of course, which will lead to the last thing. So we're going to continue to stick to things where we have an edge. And we have an edge by being patient. We have an edge by not overpaying. We have an edge by having managers who take on risks that they understand and they've thought through. Now, nobody knows the future, but you can predict certain things, at least as being scenarios. And that's really important. Foundation has brought together, thanks to all of you and others, hundreds of millions of of philanthropic capital that serves Vermont. And that scale and stability and the time horizon are incredibly important. So when we look at all this, that's just the crucial commercial, I'll stop. When we look at all of this, we're essentially thinking and saying that the world is obviously very messy. Lots to think about with that. We think about it all the time. We talk to one of the great things about our jobs, get to talk to a lot of interesting people who have a lot of interesting opinions from around the world. But the bottom line is stay diversified. Don't become short-term oriented, even though the world is quite complicated today, and think about sticking to the principles that drive long-term outcomes, not short-term outcomes. And thank you very much.
Thanks, Mike.
Great job.
Appreciate the update from Mike. I'm going to turn it over to Lawrence Miller for an update on our Vermont investment portfolio, and then we'll open it up for questions. I see there's one in the chat already towards the end of the call after Lawrence's update. As folks on the call will recall, 20 years ago, our board made a decision to allocate no less than 5% of our invested pooled assets into investments in Vermont communities to strengthen the economic and community vitality across the state. Lawrence has been with us for the last 2 years now as a senior advisor for Mission Investments. He's a former Secretary of Commerce, a founder and entrepreneur of Otter Creek Brewing, and a longtime business advisor and consultant, and has been adding great depth and value to our administration of this portfolio, along with oversight of the Vermont Investment Portfolio Committee. So thank you, Mike, and I'll turn it over to Lawrence for his update.
Thank you. And I will reverse that. The Vermont Portfolio Committee performs excellent oversight of us, and I really value their participation. We've got a few members on the call today, and their guidance and wisdom is extremely valuable as we go through our work. As Dan said, this was established with a board decision in 2001, and it's grown significantly over time. What we aim to do is align the Vermont portfolio activities with the impact areas that we follow for grant making and on a community focus that's well aligned. So we have a range of investments that are in affordable housing, clean and healthy ecosystems in the environment, downtown revitalization, entrepreneurship, and a good chunk in food and farm. So we do our work around the state in a number of different ways. When we talk about the Vermont portfolio, we're talking about two pieces. The first is that what was originated as a 5% allocation of the balance at the time, and 5% of new funds get allocated. And then we have some non-pool mission investments. These include things that were contributed to VCF along the way, and some DAFs that have increased exposure to the Vermont pool or to individual investments. We go out in the world through different ways. We mainly invest through intermediaries. So when we're talking about venture capital, we're talking about Vermont active venture capital funds like Fresh Tracks, like the Flexible Capital Fund, Features Capital, Rural Works. And they do all the heavy lifting of identifying investments and managing those investments in their part of the portfolio. And fixed income, those are the loans we make to primarily to nonprofit organizations, and we'll talk about those from time to time. This is a slide I don't bother including on a quarterly basis for the main reason that all of the stuff in the Vermont portfolio is largely illiquid with no market information. So while Mike benefits from having daily feedback on the value of most of the major plural portfolios, we have very static valuations. But we do check our work from time to time, so I look at this once a year at least. Our objective over the long term is to maintain purchasing power net of losses, expenses, inflation. And then we adjust for an individual investment. We're setting a target return. For something like a loan, for example, we set the interest rate based on the risk that we perceive, adjusted for social impact. So we might go into some fairly risky loans with a very, very low interest rate because we're fulfilling a role in those participations where the project wouldn't happen but for our participation. And so that's really a view we take at it. And so we see we've got No notable losses in the last year. We had a little bit of gain that we were hoping for on top of a pretty good return on Sun Common, but as you might have read in the paper, they ran into some challenges. We wrote off a very small amount of potential gain but overall got a really good return on that. We had no other losses. Our expenses run around 70 basis points, which for a fairly active role is pretty good. And our investment gain net of expenses after expenses for last year was 2.7%. Long haul, it's been about 2.6. So we're on track. We're adding some stuff that's a little bit higher yield given the inflation right now. But that's sort of the overall picture and what we're trying to achieve. We seem to be staying on track. I noticed this morning that one of our investments has reached a significant milestone. And I think somebody from Northern Forest is on the call today. But I noticed that the applications for apartment rents at the Railroad Street property in St. Johnsbury are up and available. This was a Vermont pool investment a couple of years ago. We came in with early money to support soft costs and will be in there for, I think, 7 years, 9 years, good long time, while it stabilizes, and then we'll get paid out of a refinancing eventually. This is also an example of a place where we've made a Vermont pool investment. And then we had donors who allocated an increased amount to the Vermont pool for further investment in this project. So we've got donors who said, this is a really neat way of approaching redevelopment in a rural community who wanted to participate. We were able to provide that tool. This month, I'd like to talk about a different project that we've got going on. I'd like to talk about examples so that the type of work we do can feel a little bit more real. The company we've been working with, I've been talking to them for almost a year and a half now, is Wheelpad L3C. They're located in Wilmington, Vermont, so right between Brattleboro and Bennington, an area that is really tourism dependent. It's a tourism and hospitality economy without a lot of diversification. So the ability to work with a manufacturer in an area that does something is got a significant amount of value. They're an L3C, which is unique. The L3C designation was created a few years ago, meaning a low-profit, limited liability company. And this is to provide a legal structure by which a board could manage a business for priorities beyond just financial return. It was originally designed to be sort of a blend between a nonprofit and a for-profit, with a way that private foundations could make a program-related investment in these or grant to them without there being a tax consequence. The IRS rules never caught up, but the overall intent of creating a tool for a social impact business has been very successful, and we've got a number of them in Vermont. What these folks do is they create modular accessible units to augment any home. And this was driven by the founder's personal experience. Their godson had a spinal cord injury and needed to be able to continue to live at home, and rehabbing the house was not feasible. But the founders are a couple of architects, and they designed a way to approach this and to do it in a very rapid way. And they're creating an affiliated nonprofit so that they've got a way to bring in money to subsidize leasing these out for low to moderate income folks. And they're also doing workforce development in coordination with job training resources in the area. So we're actually crossing across several impact areas for VCF: economic equity, health and well-being, and education and training. So what we'll be doing is providing a 5-year working capital loan for inventory, and that way they'll have items in stock that they can move directly to people quickly when they need them. And so these are attractive little units. That black bar across the top, that's a rail, so that somebody can move under their own control from their bed to the bathroom and back, right?
Nice.
The level of independence that affords is really valuable to these people, and it can be as much as a kitchenette. It can be a whole little unit, or it can be an augmentary living room, bedroom, bathroom, connected to the rest of the house for other purposes. Why does this matter? There's a lot of people for whom this becomes a reality. I've known several in my life, and it's a massive personal change to your life. And it's not as though we have a tremendous capacity in Vermont in our nursing home capacity. My wife happens to be the executive director of the trade association that serves that industry, and it's really challenged. It's not a good option for a lot of people. And the ability to stay at home with your family and in your community is a major opportunity. And because these will be an inventory that can move out quickly, when you get injured, you've got a period of time where you're going to be in the hospital and then skilled nursing facility. But then
Welcome back
it's
to
going to be time
Railroads.
not too long.
Townsbury,
And so
Vermont.
the ability to move quickly is really vital to serving these people's needs. And then they'll be that the image of everything that they're thinking about was really kind of neat. This is a complex project, complex financing stack. Our colleagues at VITA are supporting the Brattleboro Development Credit Corporation to do a own leaseback of the property to the organization. There's the affiliated 501c3. There's a preferred stock round. There's a whole bunch of different pieces that are making this work. And this is really typical of the things that we get involved in, where there's a complex capital stack with a really specific need for our participation that makes it happen in a way that it otherwise wouldn't. And I just thought it was a good one to highlight for this month. So we will pause here and take up questions.
Great. Thanks, Lawrence. I also want to recognize, just on the call, Stacy Fagan, who's our VP of Philanthropy. I didn't call her out at the beginning. Thank you, Stacy. And there, in the Vermont portfolio, there are a number of folks on the call who are actually partners in that portfolio. I see Cassie Polimas from VITA. I think I saw TJ Whalen, who's one of the partners at Fresh Tracks Capital. Marianne Taboomery, who is active in an emerging, not in the portfolio yet, but a really creative housing strategy in Plainfield, and there are likely others. Kristen Sharpless, who's with the Northern Forest Center. So just want to acknowledge those partners on the call as we open it up for questions. I will say, to bridge the gap between the two updates, Mike was pretty candid about his assessment of the aggressive run-up of certain stocks in the public markets and the concentration risk in those markets. We did have a fund holder and partner who took their earnings in one of those stocks that ran up over the course of the last year and allocated it into a new donor advised funds that was fully invested in the Vermont portfolio. So took the earning and mitigated his gains and put the money to work in Vermont communities in a really inspiring way. So there is a way of threading the needle and wrestling with that concentration risk and doing good in the community. But that said, I want to open it up for a broader discussion, and I'll start with Bill Danforth, the question that was dropped in the chat. And really, I think that's to Mike, which is, it's hard to be, it's hard to overstate the level of uncertainty and volatility and turbulence that's emerging from DC in the last 3 or 4 weeks that has both dramatic consequences for Vermonters and Vermont communities, and but also potentially broader implications for markets and investment management. So how would you recommend, as we get into the investment committee meeting after this call, what is your advice and what is your thinking relative to that volatility?
Yeah, I mean, so it's such a difficult question. And I guess I'll fall back on a really simple idea, which is that when you're faced with incredible uncertainty and incredible risk, as I think the question suggests, and Dan, as he summarized it, The answer is to go back to an old-fashioned idea, which is to be more diversified, to have your eggs not all in one basket or two baskets, but to have it spread. And I think by spread, I mean own stocks, own bonds, own other assets. Some of the riskier than others, some are safer than others. Again, it's controversial, I know, but maybe own companies around the world, maybe have exposure to different currencies. I mean, there's a whole variety of things you can do. And again, I'm not suggesting you put all your money in the yen, for example, but I'm saying it's nothing terrible about owning a little bit of Japanese stocks, which have yen exposure. There's nothing terrible about owning some European companies that have exposure to their currencies and to their economies. And frankly, sometimes great businesses that are very inexpensive, which gets to the last point, which is this is difficult to assess as an investor, and I totally understand it, but it's what we've spent our time thinking about. Try to get a sense of what you're paying for something. If you're paying for the rosiest of outcomes, the chaos and the change and the risk, those are much more painful for you as a long-term investor when you paid for perfect and you got average. When you pay for horrible, which is what that Silchester portfolio growing at 30%, trading at 10 times earnings, essentially what the market is saying, these are horrible businesses. Nothing good is ever going to happen to them, basically. And what if it's okay? Then you're fine, even in some of this climate, if you can wait it out and you can be comfortable, which is the last thing is to recognize today the structure of markets. They have changed, and in a way that doesn't necessarily serve you in the short term, but very much serves you in the long term. And by that, I mean a lot of capital is now passively managed, which is great. There's not a lot of active investors, frankly, setting price on a marginal basis, but who is setting prices on a marginal basis are hedge fund managers who run what we call pods, which are multi-manager strategies like Citadel or Millennium, if you know those names. And the key thing to remember about them, they're responsible for a giant percentage of daily trading right now. And the thing to remember about them is they trade. They're very smart people. They invest with sometimes a time horizon of 3 days. And they're only looking to catch trends one way or the other. So when you see the markets becoming incredibly volatile, some of the stocks you own becoming incredibly volatile, that's what you're looking at. Don't think that, oh my God, something important must be happening. It could be, but what's probably happening is a whole bunch of these managers are all running to the door one way or the other at the exact same time, and they're moving the prices around quite a bit. We see that as a good thing to the most part, if you can tolerate the volatility. And this climate of the geopolitical and the Washington thing, as Dan just said, only accentuates the concern and the issue. But it can be a good thing because when somebody wants to hand you $1 of assets, if you can be patient, for 20 cents, you should want that. It doesn't always feel that way when the markets are dropping, but that's what's happening is people are selling good things at low prices sometimes. And so it's very important to think about it that way. So that's a lot to say, but the key point is I would say this, I hate to say this because it's a terrible way to think about life, but be afraid. When you think that you know exactly what's going to happen, or you see a stock going through the roof and you think everything must be great forever, a little bit of fear might serve you well. That's why I do love Dan's story about selling selling an expensive stock and taking those gains. First of all, brilliant to have owned it, even more brilliant to sell it and put into something really meaningful like Vermont, and the Vermont investment pool is a fantastic outcome. So, those options will come on both sides, essentially.
Thanks, Mike. Nothing more in the chat, so I'll just open it up for other questions if folks want to dive in. A couple other quick acknowledgements. I see Rich Holshoe, another member of the VCF Board of Directors. Nice to see you, Rich. Kwai.
Hey, Dan, I can't find my hand, my digital hand to put up.
There you go, Tim.
Did I butt in? And I apologize. I don't want to step in front of anybody because I'm going to be joining Mike in the investment committee after this call, and we're going to go into some of these things in depth. Mike, you've talked a lot about kind of value versus growth and where we want to position ourselves on that axis. Another thing that we'll talk about in the investment committee today, and I wouldn't say that we turn the dials on too much over the course of the year, over the course of a few years, but it's something we keep a pretty close eye on, is asset allocation. Roughly 60%, maybe a little bit more of our portfolio is in stocks and equities. But we've got significant exposure to fixed income. And how we turn those dials over time is also, I think, an important contributor to not only performance, but where we want to be on the risk spectrum, if you will. But can you speak a little bit about, where this portfolio is positioned in that regard and things we want to be looking at as we look down the road?
Yeah, it's a great question, Tim, and you characterized it perfectly because it is a question of risk and a question of return. Now, we obviously, as you know, want to have an impact or a mission supporting return. So there's a floor underneath what we're trying to earn here. So, for example, even if we thought bonds were stunningly better than stocks, if bonds can only return 4 or 5% a year, we can't put the entire long-term pool in bonds. For example, Tim didn't suggest that, by the way. I'm just saying there are guardrails around us around what we're trying to achieve with the portfolio. But what I would say is that when we think about allocating assets today, you do have to face kind of the implication of what I was saying earlier, which is if long-term prospective U.S. stock returns are, let's say they're 6% a year from here, and bond returns are closer to 5%, the compensation you get for taking that extra risk of owning stocks isn't particularly compelling. And if we were faced with that decision, then what we would do is we would have a more balanced portfolio than we even have today. Tim referred to the 60% stocks. We probably have less. The good thing for us is that the stock portfolio that we can build it and you can build it, just have to avoid these big US stocks, is probably closer to a 9 or 10% returner going forward. So that's why we're feeling very confident in owning 60% plus in stocks. Again, assuming they're well allocated. And frankly, the big risk we're taking is the one we're living with right now, which is that if everything else is flat or down, and Tesla stock is up 65% next year, we're going to underperform. But the problem is we can't own as much in stocks if we have to put it all in Tesla and NVIDIA. And so it's a real yin and a yang thing. But the key point as an asset allocator to think about, to Tim's point, is what's your investment return goal? And then how much should you put in stocks, knowing that they are still the highest long return asset you're going to find. And today has a real tale of two cities. If you buy the stuff people love, you may not get there. If you buy the stuff people hate, and I realize that's a weird thing to say, you have a very good chance of generating a very healthy return on stocks.
Thanks, Mike. Thanks, Tim, for the question. Other questions? Cassie, Cassie's got her hand up.
Found my hand. Hi, Mike. Cassie Polimas with the Vermont Economic Development Authority. Thanks for this
Cassie.
overview. Happy to join today. I'm not sure that I saw this correctly, so I just wanted to go back to one of your earlier slides, and I thought I read capital scarcity. Is that okay? Can you just expand on that? What kind of capital, where in the risk spectrum, and how that's impacting what you all do? And what we do at Vermont Economic Development Authority, as was pointed out, is we partner often in some projects, and we're a gap lender. And so scarcity of capital is something that's always top of mind when I'm looking at VITA's impact. So I just was wondering if you could expand on that a little bit.
Yeah, sure. Can you guys hear me okay? I don't know if my Wi-Fi connection is struggling here. Can you guys hear me?
We can hear you.
We can, Mike.
Frozen.
Okay. I might turn my video off just in case there's a Wi-Fi issue where I'm at. So yeah, Cassie, so I was referring to, thank you for that background. It's really helpful. I was referring to, with capital scarcity, probably more at a macro level to start, which is just a
I think we lost you, Mike.
Sorry about that, Mike. Sorry about that, everyone.
While Mike stabilizes, let me address that on a more micro level from what we're thinking about the Vermont portfolio. I missed noting that Joan Goldstein is on the call, and here's an example. In the project that I was describing with Wheelpad, the agency of the Department of Economic Development was able to make a grant to the Brattleboro Development Credit Corporation, which is going to be the owner of the property. That formed the equity component so that VITA could lend into the project. That said, these things get complicated. But there's an example of funding sources, right, that are changing. And as we talk to many of the nonprofits we work with, they're uncertain about what their funding sources may be. As we look at different forms of federal supports that come into a lot of these projects, there's a great deal of uncertainty at the moment. So I'll let Mike, now that he's rejoined, go back to the macro level observations on capital scarcity. But at the micro level, we're looking at disruptions in the capital stack of projects that are in flight or organizations that we partner with in their charitable work that are facing some significant vulnerabilities and largely uncertainty. And so we're thinking a lot about that as well. Mike.
Thanks. Thank you, Lawrence. So I always on the road have 3 or 4 internet sources with me. So the first one died, so I'm trying the second one. So I apologize for dropping off. Thanks for bailing me out, Lawrence. So Cassie, yeah, I was speaking but there are implications, and Lawrence, I think from what I could just hear was getting into some of the more specific issues. But the top-down issue for us that leads us to talk about capital scarcity, first of all, it's a bit of a relative term, just to be clear, and I don't have the graph handy, but if you looked at the Federal Reserve's balance sheet, thanks to quantitative easing over the last 14 years, it kind of skyrockets from nothing to trillions and trillions of dollars. And now they have been, since 2023-ish and 2022, when inflation started to pick up, they've been letting that balance sheet shrink essentially, which is that what that does is it's essentially taking capital out of the system. And what's been interesting about it, though, is that to some degree, the effects have been muted because the US government, of course, from a fiscal perspective, under the Biden administration, was actually pumping through deficit spending and through a lot of treasury maneuvering, was putting capital back in the system, sort of kind of canceling out the Fed's impact from what they were trying to do. So now that we're in this new administration where gosh, who only knows what they're going to do. But the fact is that the Fed's continuing to let its balance sheet run off, which sucks capital out of the system. The government I don't know, we can't tell what they're going to do, so I'm not going to try to speculate on that. But they're certainly creating a lot of uncertainty, which is bad for capital deployment, as you know all too well. It causes people to pull back. It causes companies to pull back, and people get nervous, which gets to the key point, which is that what we're worried about while we bring up this topic is that the way it starts to pervade itself through the lending process, as you're describing about in Vermont, the way it pervades itself, for example, in the venture capital community is going to be very interesting to see. Because you have a lot of the same problems you have in other parts of our society. Like we just about venture capital for a second. So much of the capital is concentrated in a few big venture capital managers right now. A lot of the smaller ones are struggling to raise capital as we speak. A lot of smaller firms in general are. So it's creating a very concentrated the system's getting more and more concentrated in everywhere you turn, which is inherently unhealthy. And so we're worried that all these things come together, and all it does, the last piece of the pie in terms of really hurting some of the availability of capital, broadly speaking, is to actually, unfortunately, see what I keep talking about actually happening, which is some of the re-rating of these big U.S. companies. So much wealth is tied up in these businesses right now that I think you saw the other day when the DeepSeek thing came out. I think NVIDIA lost $500 billion in market capitalization. I mean, that's a massive number, and it does have knock-on effects on the way people approach risk-taking in their lives, and companies do as well. So capital scarcity is really top-down, with a lot of implications that affect everyone eventually. And all we're really trying to say is there's just a lot more risk, as you know. And unfortunately, Cassie, your job gets much harder. And I'm sorry about that, because it's just more and more need, and not necessarily as much capital as you need to fill that need.
Thanks, Mike. Other questions? Ron Miller.
Hello, Ron Miller from Vermont Humanities. I'm the treasurer. Is there any adjustment in the criteria that are being used for choosing investments in the socially responsible pool?
Dan, do you want me to answer that? Do you want to answer that?
Yeah, I think that's a topic for, the investment committee coming up as we look at asset allocations for the kind of coming year. That's the topic of the January the January committee meeting. So we'll be looking at that. in a little bit. I'm not sure, Mike, if you have recommendations or as we dive into that meeting, whether we're going to be looking at tweaking any of those allocations or what we're looking for managers. Broadly, I mean, I think we've been pretty consistent in, in that selection of managers. And generally, the advice we get from Crucial, to put words in Mike's mouth, is, patience and diligence over time is generally going to be the generate longer term stable and less volatile returns. So Mike, I'll let you dive in if you have anything on the horizon relative to the socially responsible pool specifically that you want to highlight.
No, the only thing I would say is that the committee has started to use, first of all, Ron, great question as well. And the committee has started to use some new tools. We're using at Crucial to try to measure impact a little more strongly, in terms of things like carbon footprint, things like social measurements, both good and bad, about what companies are doing. So the committee has been starting to look at a more robust data set. And I think that will pervade all of the foundations investing at some point here, because I think, even though I know a lot of these topics have suddenly become controversial, but, we're doing what Dan just said, which is we're being patient, we're being diversified, and we're being risk aware. And that's where a lot of the change in the world and thinking about socially responsible investing in general, it means a lot of different things to a lot of different people. But one thing it should always mean is that it's about responsibility is directly tied to investment outcomes if it's done right, and better investment outcomes, i.e. taking on less risks that are uncategorized or unconsidered, not considered. So a lot of things will come out of it, Ron, but basically right now, I think we're at this place where there's a new tool. Decisions, not today specifically, but in the next few quarters, will be made with that as a new input for the committee, plus some assessment from our team around the intentionality of some of our managers around this. Because I will say, I'm not sure about how you guys feel about this, but I sometimes find a lot of socially responsible, or ESG, if I may use that term, funds to be somewhat unsatisfying, because basically all you're telling me is that you're not going to buy this company. And I have to ask myself the question, well, what impact are you actually having? Are you changing ExxonMobil's cost of capital by not buying shares? I don't think so. So thinking about actual impact, how do you change behaviors? Again, this is getting super complicated, as you know, today. But needless to say, we're committed to this work.
I jump back on it, give a little more context. And I saw Tim Briglin come off, so I invite Tim to dive in. But I think, Ron, one of the things we've been really working to think about is understanding the entirety of the impacts of our total portfolio, which is to say that social responsibility and community impact are, there's a relative scale from, a negative zero-sum impacts to the Vermont portfolio, which is highly tied to both impact and place and purpose. And so looking at the entirety of our portfolio through some of those with that understanding in mind is something we as an organization are very much committed to doing, actually in the pretty near term. That said, one of the challenges of the traditional social responsibility ESG screens is that from our perspective, when we look at the conditions that are vital to us as a place-based foundation, the conditions of rural communities, the economic decline, the demographic decline, the social implications of those kinds of things, they're not frequently reflected in those traditional tools. So that's why I sort of want to step back and widen the aperture and understand, basically from a net impact perspective, is our portfolio and our activities across that spectrum of capital generating positive impact on the things in the places that we care about the most. And that net impact assessment is something, we're really excited to dive into. And in that sense, the distinction between some of the managers in the SR pool and, some of the managers in the long-term pool get a lot blurrier. And there are managers in the long-term pool who actually have higher, scoring on the tools than some of the ones in the SR pool. So I think we're looking at that commingling a little differently as we look forward in the next few months. Tim came off mute, so I apologize. I want to acknowledge him as chair.
I don't have much to add to that, Dan, but I would say that this is something that we're looking at very closely. I think there is going to be folks who are invested in the socially responsible pool are going to see more active management of their assets over the next 6 to 12 months. The socially responsible pool has had much more capital dedicated to passive indexed approached investments. But that's also being done with an eye very much on continuing to align our assets with kind of mission focused ESG focused investments. So that's one thing that I think people can keep an eye out for in the next 6 months.
Apologize, I keep putting on mute because I got a sick kid in the other room playing a podcast pretty loud, so I apologize for that. We're just about at time. If there are any questions we didn't get to, I want to just do a quick fishing exposition. Is there anybody who wants to ask a final question? If there are lingering questions or epiphanies or things that pop up, please don't hesitate to reach out through your philanthropic advisor. Ping me, and we're happy to dive in greater detail as those things arise. I just want to note this is one of the largest turnouts we've had in a while for one of these calls, and I just really welcome everybody's engagement and interest in understanding the activities that the investment committees are taking with the philanthropic capital that you all have entrusted us with, and is going to become increasingly important as we look ahead in coming years on the implications of all of this volatility and uncertainty on the conditions of Vermont communities. So thank you all very much for your partnership, and please stay in touch.
Bye, everyone.
Everybody, thank you so much.